Right? Here's two companies, and your investing career, 40 years, seems like a long time, but actually most of us, given our lifespan now, are going to be investors for much longer than 40 years. Actually, even if we start in our 30s, say, we're going to be investors for much longer than that. And these two companies are, you've got a very simple choice. You've just got to own company A or company B for the 40 years. That's all it is. That's all you're required. Company A has a return on capital employed of 20%, and B has one of 10%. To make this simple in terms of mental arithmetic, so you don't have to do complex mental arithmetic, neither company pays a dividend, so 100% of their post-tax returns are invested in their business, and they both have the same tax rate. So I hope, having bored for Britain on return on capital employed for the last 20 minutes or so, I could convince you that A might be the better investment to select. However, if only life were that simple. On the day when you go to buy them, they are differently rated. A is trading on 4 times book value on the stock market. B is only 2 times book value. For those of you who are not analysts, book value is the capital, take it as the capital employed there. So for every pound of capital employed in this lovely 20% earning company, you've got to pay 4 in share price terms. Whereas unsurprisingly, with this one that only makes 10%, you've only got to pay 2. Bit trickier, isn't it? Which one do you want now? It gets worse. When you come to sell them 40 years later, because you want to invest in bonds and lose money, this one has halved in valuation. I have no idea why it's occurred. It's out of fashion. Your timing is bad. For whatever reason, just take my word for it, it's happened. It's gone from £4 for every pound of book value to £2. This one, conversely, is in fashion at the moment. It's doubled its valuation. Now, which one do you want to own? It's still A. Now, believe it or not, and we can send you the spreadsheet for anybody who wants this if you ask us afterwards, you've actually got enough information here, not for the gobbledygook that I talk about, return on capital employed, price of the book. You've got all the data there where if we tell you the share price at the outset, we can tell you what you would have gained at the end and what the compound return would be. You've got everything you need there in those few numbers. Your terrible timing here, but in this very good company, would have cut your share price compound annual growth rate to 18%. You'd have taken 2% off from what Charlie Munger tells you is the underlying return. With this one, your brilliance, or luck, I don't know which it is, would have got the return up to a whole 12%. Over the long term, it's the return that the company makes on the capital it reinvests, which will determine your outcome, not whether you buy it cheap and sell it expensive or the other way around.